Can you do a 1031 exchange on inherited property? Yes, you can do a 1031 exchange on inherited property when the property qualifies as investment or business use real estate. But most heirs should first ask whether there is enough post-inheritance gain to defer. In many inherited property sales, the basis adjustment at death changes the tax picture. The property usually starts with a new tax basis near fair market value at the date of death, so the lifetime gain that built up before inheritance may not be the gain you are trying to defer. I am Rhett Fruitman, co-founder of Inherited Property Match. My background includes City Private Bank, CBRE, and helping families navigate inherited property sales across the country. This is general information, not tax, legal, financial, or real estate advice. Before you sell inherited property, speak with a CPA, and when probate or trust administration is involved, an estate or probate attorney. Why do most heirs not need a 1031 exchange right after inheritance? Most heirs do not need a 1031 exchange soon after inheritance because the property usually receives a basis adjustment to fair market value at death, which can eliminate tax on pre-death appreciation. Do heirs pay capital gains tax if they sell inherited property right away? They can, but the gain is usually measured from the inherited basis, not the deceased owner's original purchase price. For example, if a parent bought a rental for $200,000 and it was worth $500,000 at death, the heir's starting basis is often near $500,000. If the heir sells soon after for $510,000, the 1031 question is usually about $10,000 of post-death appreciation, not $300,000 of lifetime appreciation. That is why the first step is confirming the stepped-up basis with the estate CPA. When does a 1031 exchange for inherited property make sense? A 1031 exchange makes sense when the inherited property is held for investment or business use and has appreciated meaningfully above the stepped-up basis. Can you do a 1031 exchange on an inherited rental property? Yes, an inherited rental is usually the clearest candidate if the heir continues to hold it for investment and wants to reinvest in another investment property. This often comes up after an heir keeps a rental for several years, inherits commercial real estate, or wants to move equity from one market into a better-fitting property. The exchange may defer recognition of the newer gain, but it does not make the tax disappear. Can you use a 1031 exchange on an inherited personal residence? No, a 1031 exchange does not apply to inherited property held only for personal use. Internal Revenue Code. Section 1031 is for real property held for investment or used in a trade or business. An inherited family home or personal use vacation property does not qualify just because it is real estate. Can you 1031 exchange a house that used to be a personal residence? Only if the facts support investment or business use before the exchange. A personal residence may also raise a separate Section 121 home sale exclusion question, but Section 121 is not the same thing as a 1031 exchange. What are the core 1031 exchange rules heirs need to know? As of 2026, a typical deferred 1031 exchange requires like-kind real property, a qualified intermediary, written identification of replacement property within 45 days, and receipt of replacement property within 180 days, or by the tax return due date, including extensions, whichever comes first. The property being sold is the relinquished property. The property being bought is the replacement property. Both must be real property held for investment or business use. What happens if heirs receive the sale proceeds before setting up the exchange? In a typical deferred exchange, receiving the proceeds can break the exchange. The money should go to the qualified intermediary, not directly to the heir, the estate, or the trust. The exchange is reported on IRS Form 8824, so the CPA should be involved before closing, not after. How do boot and related party rules affect inherited property exchanges? Boot and related party rules can create taxable gain even when the inherited property itself qualifies for a 1031 exchange. Boot means cash, debt relief, or other non-like-kind value received in the exchange. If an heir takes cash out, buys down into a lower value replacement property, or reduces debt without replacing it correctly, some gain may be recognized now instead of deferred. Can siblings use a 1031 exchange if they inherited property together? Sometimes, but it gets complicated when some heirs want cash and others want replacement property. The taxpayer doing the exchange has to be consistent, and the ownership structure should be planned before the listing agreement is signed. Related party exchanges can trigger special reporting and holding period rules when family members, estates, trusts, partnerships, or related entities are involved. Can an estate or trust do a 1031 exchange? An estate or trust can potentially do a 1031 exchange when it is the taxpayer that owns qualifying investment or business use real estate, but the taxpayer identity has to stay consistent through the exchange. Can an estate do a 1031 exchange? Potentially yes, if the estate owns the relinquished property and completes the exchange as the taxpayer. Can a trust do a 1031 exchange? Potentially yes, if the trust owns the property and completes the exchange as the taxpayer. Once title moves to individual heirs, the heirs are usually the taxpayers. That shift matters because the person or entity selling the relinquished property needs to match the person or entity acquiring the replacement property. Probate delays can make planning harder, but they do not automatically extend the federal 1031 deadlines once the exchange clock starts. What estate and title issues make inherited property 1031 exchanges harder? The hardest inherited property 1031 problems usually come from title, entity ownership, probate timing, and co-heir disagreement. A deeded real property interest may qualify. A partnership interest usually does not. If the property is inside an LLC, the LLC tax classification matters before anyone assumes a 1031 exchange is available. If multiple heirs want different outcomes, some families need title planning, trust or estate guidance, tenancy and common analysis, or entity-level tax advice before the sale process begins. This is where the real estate process has to line up with the tax process, title process, and any probate or trust administration process. What is the safest way to approach a 1031 exchange on inherited property? The safest approach is to confirm the stepped-up basis first, estimate the post-inheritance gain, identify the taxpayer on title, and line up the CPA, attorney if needed, and qualified intermediary before listing the property. If the gain is small, a normal sale may be simpler. If the property has appreciated well above basis and the heir wants to stay invested in real estate, a 1031 exchange may be worth exploring. If you inherited property and need help finding a broker who understands estate-related sales, Inherited Property Match can connect you with a vetted broker experienced with inherited property. The match is free.